Welcome to this deep dive from Talk Tickers. We're your professional guide through the complex world of earnings calls, breaking them down into, well, clear and actionable intelligence for you. Today, we're digging into the SLB Schlumberger Q3 2025 earnings call. And our mission, it's pretty critical this time. We need to look past all the noise, the M&A stuff, the divestitures, those one-off issues.
Yeah, there's a lot going on.
Exactly. And we need to uncover the real story management is trying to tell. Because this isn't just the same old oil field services narrative anymore. This is about SLB deliberately transforming, pretty rapidly actually, into a production recovery and, interestingly, a digital powerhouse.
Absolutely. It's really essential this quarter to, filter the signal from that noise. Q3 was, let's face it, inherently messy because of all the portfolio changes.
Right.
But the underlying strategic direction, the growth drivers, they're becoming incredibly clear. And if we can sort of separate those temporary blips from the real structural shifts, well, the investment story starts to look quite compelling, I think.
And so let's start right at the top then. Just the snapshot results for Q3 2025. Adjusted earnings per share. That came in at 69 cents. That was actually down 5 cents sequentially.
Mm-hmm.
But total revenue was $8.9 billion, which is up 4% sequentially. So on the surface, you might look at that and think, okay, modest, steady growth.
Yeah, but that 4% number, it's pretty misleading on its own, isn't it? We really need to unpack the full picture for you.
Okay.
So the good news, the tailwind, was definitely the ChampionX acquisition coming into the numbers. That business added 2 months of revenue, and it was significant, about $579 million sequential uplift. That's a big chunk right there.
That's huge.
It is. But that massive gain was almost completely wiped out by two major non-recurring issues, headwinds, basically.
Mm-hmm.
First, they flagged a $100 million revenue hit because of a pipeline disruption down in Ecuador.
Right, I saw that.
And second, there was another $100 million revenue hole because they sold off that Palliser APS project up in Canada.
Okay, so if we do the math here, we take out the $579 million positive from ChampionX, but then we kind of add back the $200 million loss from those two unusual events in Ecuador and Palliser.
Exactly.
You quickly see that on a like-for-like basis, sequentially, the core Q3 revenue was basically flat. That's a really crucial adjustment to make, isn't it?
It absolutely is. And it's something the market had to digest. These disruptions also hit profitability, as you'd expect. The adjusted EBITDA margin came in at 23.1%.
Okay.
And management was specific here. They said the Ecuador issue cost them about 60 basis points on that margin, and the Palliser sale knocked off another 30 basis points.
So for listeners, a basis point is 1/100%. We're talking almost a full percentage point of margin just gone due to things that shouldn't happen again next quarter.
Precisely. It means the underlying profitability, the core engine, is still running strong. It looks quite robust once you strip out that noise.
Okay, let's talk about that core business then and these strategic pillars, because this is where the story really shifts, starting with what they're calling the digital revolution. Q3 was the first time they actually reported digital as its own standalone segment. That feels like a big signal about how important it is internally.
It definitely does. And the numbers themselves are, well, pretty exciting. Q3 digital revenue hit $658 million. That's a very strong 11% sequential jump.
Wow.
And the margins, they're already looking like something you'd see from a tech company, frankly. 32.7% adjusted EBITDA margin. And that was up 123 basis points just from Q2.
And they're structuring this quite deliberately, aren't they? 4 categories. Platforms and applications, digital operations, digital exploration, and professional services. That platforms and applications bit seems really interesting, focusing on recurring revenue.
Exactly right. That's where the focus is, creating a resilient, almost software-like business within SLB. Mm-hmm. When you look at platforms and applications, that includes things like their cloud platforms, Delphi and Lumi, the key thing is how sticky it is with customers. They reported 103% net revenue retention rate.
Okay, that's a fantastic metric. So for you listening, 103% net retention means customers aren't just staying, they're actually spending more year over year, buying more modules, more services.
Precisely. It shows the value they're getting. And the sort of headline number here is the annual recurring revenue, or ARR. That hit $926 million at the end of Q3.
Almost $1 billion.
Getting close. And management sounds very confident. They're projecting high single-digit sequential growth again in Q4, and they explicitly said they're targeting $1 billion in ARR within the next year.
Hitting that $1 billion mark and predictable recurring software-type revenue.
Yeah.
That could really change how the market values the whole company, couldn't it? Is that target, you think, is it achievable? What are the risks? Maybe if global exploration stays a bit muted.
That's a fair question. I think the risk is somewhat mitigated because these platforms get so embedded in how customers operate day to day.
Yeah.
That's why you see that high retention rate. And their whole thesis isn't just banking on, lots of new drilling.
Right.
They specifically guided that digital revenue should visibly outperform global upstream spending overall.
Mm-hmm.
And they expect it to grow faster than their core service business by double digits. That's a strong statement.
Yeah.
And they're targeting a full-year EBITDA margin for digital of 35%.
Yeah.
Again, that's a tech margin, not your typical oil field service margin.
And we can't ignore that other piece of digital, the part that's not even traditional oil and gas, the data center solutions business.
Yeah, that's the part that's really making people sit up and take notice. It's high growth, it's low capex, and the customers are the big hyperscalers, the cloud giants. It's being driven by the whole AI boom needing massive data center capacity.
So SLB is using its industrial know-how for cooling and automation in that space.
Exactly. It's leveraging existing expertise, but for a totally new external market. It gives them growth that's, completely uncorrelated with oil prices. It's quite fascinating.
It really is. Almost like a stealth tech play inside this energy giant.
Yeah.
Okay, let's shift gears then to the second big pillar, the production systems power play, which now has ChampionX fully folded in. Production systems revenue jumped 18% sequentially to $3.5 billion. That obviously reflects ChampionX's production chemicals and artificial lift businesses.
And this integration, it's really key to their strategy for dominating the whole production lifecycle. When we talk artificial lift, just to clarify for listeners, we mean the tech pumps, gas injection, things like that used to keep oil and gas flowing as reservoirs get older and pressure naturally drops off. It's a pretty resilient market, more OpEx driven.
Right, operational spending.
Yeah, exactly. Management sees this ChampionX deal as absolutely critical because it immediately positions SLB to tackle both OpEx and CapEx markets, all focused on production recovery, squeezing more out of existing fields. And given that decline rates are, a constant battle globally, this business line should offer much more stable, almost annuity-like revenue compared to just relying on the drilling cycle ups and downs.
So how's the integration actually going? Are they hitting those synergy targets they talked about?
Management sounded, frankly, pretty enthusiastic. They seem very happy with the execution so far and the immediate boost to margins. The targets are still aggressive, $400 million a year in pre-tax synergies within 3 years.
Okay.
But crucially, they expect to get there fast. They're projecting 70% to 80% of those savings realized within just the first 24 months.
Wow, that is fast. It suggests it's not just about, cutting overlapping costs. They must be cross-selling already.
That's the idea. Leverage the whole combined portfolio. The lift tech, the intervention services, the chemicals, and importantly, the digital platforms we just discussed to offer a complete package. They're selling production optimization as a solution, not just individual bits of kit or service.
Right, moving from just selling stuff to selling outcomes, more barrels at lower cost.
Correct. It changes the customer relationship, makes SLB more of a strategic partner in managing that inevitable field decline, which is, a huge challenge for operators everywhere.
Okay, so looking ahead then, let's talk guidance. Q3 was noisy. What are they telling us to expect for Q4 and the full year?
Yeah, they guided for a pretty clear sequential step up in Q4. They're projecting high single-digit sequential revenue growth for the quarter. That's based on getting a full 3 months of ChampionX contribution, plus the usual sort of year-end bump in software sales and product deliveries.
And what about margins? Are they confident those Q3 hits from Ecuador and Palliser were really just one-offs?
They seem to be. Adjusted EBITDA margin is expected to expand quite nicely, somewhere between 50 and 150 basis points sequentially in Q4.
That's a decent jump.
It is. And that confidence allowed them to basically reaffirm their full-year picture. They confirmed that second half revenue should land right around the midpoint of their previous guidance range, which was $18.2 billion to $18.8 billion. So, despite the Q3 bumps, they're showing they can execute.
All right, let's zoom out a bit now and think about the broader investor context. Management keeps saying the long-term fundamentals for oil and gas look constructive. We hear that statistic all the time. Global inventories are low, and something like 90% of upstream investment every year is just needed to fight natural decline. That implies a kind of floor under spending, right?
It does suggest a baseline level of activity is needed. But the really crucial shift, and this is where SLB seems well positioned, is where that capital is going. Management was very explicit on the call. They believe international markets are set to lead the activity rebound. That's a big change from the U.S. shale boom era.
Okay, why the confidence in international leading the way?
Well, it's a couple of things. First, international projects are often driven by national oil companies or the big integrated majors, and they tend to focus on longer-term capacity expansion, especially for natural gas right now.
Right?
Second, the economics in North America, particularly U.S. land, are still quite tight. Operators there are really focused on efficiency gains, preserving cash, not necessarily rapid growth. So North American activity, while okay, is probably going to stay somewhat muted, according to SLB.
So international offers longer-term visibility and maybe better margins.
Potentially, yes. And there are two specific international areas they highlighted as catalysts to watch. First, deep water. They think activity there is going to bottom out in Q4 of this year, 2025.
Okay.
And then they see a gradual strengthening through 2026 and into 2027. The economics for new deepwater projects actually look pretty favorable again.
Interesting. And the second catalyst?
Saudi Arabia. The thinking is that activity there has kind of found its floor after a period of adjustment. Management expects a rebound, probably starting in the first half of 2026. That's driven by their goals to expand gas production and also maintain long-term oil supply security. That points to a multi-year drilling effort that SLB, with its scale and digital integration, is obviously very well placed to benefit from.
So this really paints a picture of a shift in where the big money is going in the industry, away from the kind of short cycle U.S. land towards these longer duration international gas and deep water projects.
Exactly. And SLB's portfolio seems tilted towards capturing that shift.
All right, now for our favorite segment, the not financial advice segment. Just a reminder for everyone listening, this is purely speculative. It's an idea sparked by the themes on the call, just to get you thinking. It is absolutely not financial advice. Do your own research.
Okay, disclaimer understood. So, given everything we've heard, the clear strategic pivot, I think the most, let's say, outrageous but plausible trade idea stemming from this call would be a pair trade. You go long SLB and you short a basket of, say, high leverage, pure play North American pressure pumping companies.
Ooh, okay, that's definitely playing a theme. Aggressive. Walk us through the thinking there. Why bet on that specific divergence?
Well, the rationale flows directly from the call, doesn't it? It clearly signals this multi-year value migration away from those volatile short-cycle U.S. land services.
Yeah, pressure pumping.
Exactly. And towards more stable OPEX-driven production recovery, and critically towards recurring digital revenues. Those revenue streams are just inherently less exposed to the boom and bust of U.S. land CapEx cycles.
Right.
So by buying SLB, you're buying into that resilient international recovery story, you're buying dominance in production optimization, and importantly, you're buying that high-growth digital segment targeting 35% plus margins.
Oh.
And the short side, against those pure play U.S. land pumpers, acts as a hedge. It bets against the muted activity and the relentless focus on efficiency that SLB management themselves seem to expect will continue to cap the upside in the U.S. land market for the foreseeable future. So really, this trade is a bet on SLB getting a significant multiple re-rating as those sticky high-margin digital revenues become a bigger and more visible part of the whole company value.
A very clear thesis, betting on the transformation story over the traditional cycle plays. I like it. Okay, so just to wrap up this whole deep dive then, the big picture for SLB is this massive strategic pivot underway. They're using ChampionX to really dominate the whole production recovery space, hitting both OPEX and CapEx spending. And at the same time, they're aggressively scaling up that high-margin digital division, aiming for that crucial $1 billion ARR target.
Yeah, and the future focus seems decisively international now, shifting away from the short-cycle U.S. dynamics. They see clear long-term catalysts on the horizon, deep water picking up, the Saudi rebound expected in 2026 and beyond. They're really building both a tech and an operational moat around that whole production optimization lifecycle.
So the final provocative thought for you, our listener, to chew on tonight.
Okay, here it is. Given that SLB specifically highlighted their growing data center solutions business, remember, high growth, low CapEx, driven by AI and cloud, with non-energy customers, how quickly will the market start to assign SLB more of a, maybe, tech industrial multiple? If digital actually hits that $1 billion ARR next year and the margins stay up there near 35%, what's the true sort of unconstrained potential size of this digital market for them globally? And how much longer can SLB just trade like a pure play oil field services company? I think that potential valuation gap, that divergence, is where the really interesting long-term opportunity might lie.
That is a fascinating question to ponder. Food for thought indeed. Thank you for joining us for this deep dive into the SLB earnings call. We'll catch you on the next one.